The conventional wisdom is that the stock market is driven by movements in productivity. Stocks as a whole go up when firms become better at doing whatever it is that they do. However, in our research, we identified alternative forces, especially redistribution between workers and owners of capital, that actually play the dominant role in driving the stock market, especially at long horizons. Now, to understand this, let's take a step back and think about a firm. A firm, roughly speaking, bakes a pie of revenues with its sales, and then cuts that pie into two pieces. First, a piece goes to workers in the form of wages and salaries, and the other piece left over, more or less, goes to profits that can be paid to shareholders. So why might the price of stocks move? Well, one thing that could happen is that firms in the economy become more productive, increasing the size of the pie. This would increase the size of both slices, including the profit slice, making shareholders happy, pushing prices up. Alternatively, the size of the pie could remain fixed, but firms could cut a smaller share for the workers, leaving more left over as profits, also pushing prices up. We would call this a redistribution story. Finally, both the size of the pie and the slice could remain fixed, but investors for whatever reason could become more confident or more tolerant of holding a risky asset. This would also push prices up, and we would call this a market confidence story. So which of these forces move stocks and at which horizons? Well, we find in the short run that the aggregate stock market is driven almost completely by shocks to market confidence. Simply speaking, stocks move too much at horizons of a quarter or a couple of years to be explained by underlying movements and fundamentals. So it has to be something about confidence. But we find in the long run, at horizons of 20 or 30 years, that movements in redistribution are actually key, explaining up to half or perhaps more of the variance. Why do we find this to be true? Well, these movements in redistribution are very small. They don't explain much quarter to quarter, but they're very persistent or almost permanent, so they can build up over time to have huge effects at long horizons. Moreover, because workers actually get the bigger slice of the pie, about 70%, small movements in the workers' share can actually induce large proportional movements in the leftover profit share. Now, surprisingly, we find that productivity, the sort of conventional story, doesn't really seem to play a large role at any horizon. Now, certainly, movements in productivity matter a lot for the stock price of an individual firm, but for the market as a whole, it doesn't seem to be the case. Not only are movements in stock returns way too large to be explained by the underlying movements in productivity, they don't even seem particularly correlated. It's not that the market's overreacting to movements in productivity, it's just moving in an unrelated direction. So as strange as it sounds, productivity actually plays a very small role, while these movements in redistribution and market confidence really drive the market.